Well, hello, everybody, and thank you for joining us today. My name is Jesse Hill, and I'm the president of Tier 3 IT Solutions. And I'm really happy today to be putting on this session so that we can all talk a little bit more about the options that are available to you as business owners when you are acquiring equipment. Now, in our case, we're going to talk computer equipment because that's the sandbox that we play in. But this session really came about because we get a lot of clients who ask us, when they're making a larger purchase or taking on a larger project, what options they have other than just writing a check. So Richard Houle is with us, and Richard, if you don't mind introducing yourself, and then we'll talk a little bit about this question and the scenario we put together.
Sounds great. Thanks, Jesse. My name is Richard Houle. I'm a partner with HLH. It just so happens I've got a ski sign behind me here with HLH, conveniently. But our firm works primarily with owner-managed businesses, helping them with their tax needs as well as any corporate structure planning that takes place. And we help them with some lean solutions as well. So really focus on owner-managed businesses and helping them with cash flow and tax. And any other restructurings that they might have. So this is a great topic, very relevant to many of our clients and hopefully to all of you on the session here today.
Yeah, and part of the reason I appreciated working with Richard on this is because he mentioned it real quickly there. Oh, we help people with lean strategies. And if you look at their branding, they're very focused on process improvement and getting a little bit more into the weeds and the inner workings, I think, than what a lot of accountants typically do, where they're working on those review basis and that kind of stuff. So again, great to have you here. So the question comes up as we're meeting with our clients. We put together a scenario here, and we're going to walk through the options. A lot of times when we're going to meeting with them and we're talking about maybe a big project that they have coming up, and not every business owner has planned in advance when they have to make a big purchase. So they'll ask us, should I buy it? Should I lease it? Should I finance it? And I mean, we're IT guys, so we say, well, yeah, pick whatever works best for you. But there are benefits and analysis and tax complication or implications that go into it. So the scenario that we put together is just a made up one where we're meeting with a client and we have a $50,000 project on their roadmap. And this project is comprised of three different things. There is hardware. So let's say they're replacing their server. So they've got a physical piece of equipment that they're going to purchase. In order to make that work properly, they have to have software, right? The operating system and whatever licenses go along with that. And then we're going to have to come in and we're going to have to send technicians on site to do the actual implementation work. So this scenario, we're saying altogether these three things come out to be about $50,000 plus our GST. Hardware makes up 25,000, software makes up 10, labor makes up 15. Now, this type of scenario is, fluid. I mean, it could be that you're thinking of replacing a photocopier, or you're thinking of replacing a bunch of, laptops, or, any kind of, acquisition of equipment that you might be making. I mean, maybe you want to buy a bunch of lawnmowers for your lawnmower business, right? It's all interchangeable. So, Richard, let's talk a little bit about, what their options might be when they're thinking about making a purchase of this size.
I generally look at three options. And again, I completely echo your comment. This does not need to be specialized to computer equipment. But in this context, generally, you've got three options. You can finance it yourself, either use cash or typically it might be a bank borrowing at standard commercial rates. And if you've got a friendly banker, well, that always helps. Yeah. And then you've got lease options and two general types of leases. You can lease for the life of the asset and then take it back for $1 at the end of the day and basically buy out the lease and keep the equipment. Or sometimes you've got a lease situation where you only lease for a shorter period of time and you do not take the equipment back, or at least there's no bargain purchase. You commit to buying back the equipment, or you commit to having the option of buying back the equipment at its fair value at the end of the lease term. That's another option. And then this is something you'll know more about than I do, Jesse, is software or hardware as a service, right? And we can touch on that a little bit afterwards. But generally, I see these options as you lease with a $1 bargain purchase option, or you lease with a fair value buyout, or you get your traditional bank financing.
Yeah, and you brought up the hardware as a service. So that's not a term that a lot of people recognize, but we talked about it in our lead up. And I'm always big on analogies. And the one that I use often is I say to someone, imagine you needed transportation for your business, right? You can walk into a dealership, lay a stack of cash, or give them a check. Like you said, self-finance it. You can take their financing where you're committing to buying it. You can lease it, right? So those are all three options, that are available there. But the other option is I could walk into a car rental operation like a Hertz or an Enterprise, and I can rent that car by the day, really. And so when I think about, getting that transportation, if I plan on owning that thing until it doesn't turn over anymore and it's rusted out and it's, in a field somewhere, I might say, okay, long term, I'm going to buy it because I'm going to use this thing until there's no value left in it. The leasing option is kind of a midterm solution where I say, I need it for, 1 or 3 or 4 years, pretty sure, but I don't know what I'm going to do with it at the end. So I'll lease it so that I am guaranteed that the dealership will take it back. Or the rental thing says, well, if I don't need it tomorrow, then I don't pay for it tomorrow. And if I need it the day after tomorrow, then I go in and I get it the day after tomorrow. And each of these scenarios has a benefit and I think a cost associated with that benefit, right?
Yeah.
And you mentioned the one thing about returning the lease. That is actually one thing that traditionally, when you lease computer equipment, they don't usually want it back, right? Like there's not a lot of residual value available there. But it is an option, with the fair market value ones. So anyways, we've got this scenario. So we're sitting in front of a small business owner and you're saying, these are your three options. You can finance it, lease it, hardware as a service. How would we decide what makes the most sense for a small business owner?
I would look at a couple of key things. One of them, what you brought up, is what's your intention? Really, what's your intention? Do you truly plan on holding this equipment for many, many years and like you said, maximize the useful life on this? Or is your intent really to, listen, I want the best, I want the latest equipment, again, be it software, hardware, be it a vehicle, do I want the latest and greatest, and I need to or want to transfer into something new every 2 to 3 years?
Right.
And if that's your case, that may fall into more of a leasing or renting type of situation rather than ownership. Ownership fits really great if you want to maximize your useful life and pay once and pay the least expensive amount and just maximize your usefulness on that asset. That's one of the key, I would call that probably your number one consider point.
Mm-hmm.
Yeah. Next would be the interest rate. So in these various circumstances, there's always an implied interest rate in the lease, whatever lease you go to, and regardless of which company you do this through, who the underlying lease provider is, there's going to be an implicit interest rate built into that lease. And that really can be compared to, well, what would your banker give you? And And in today's business environment, maybe your banker would give you a loan at prime plus 1.5. Again, it depends on your relationship with your banker. It depends on your credit history, your credit strength. Typically, you'll find that leasing will often result in an interest rate that's a few percentage points, anywhere from 1, 2, 3, 4 percentage points higher than a traditional bank loan. But again, it's a trade-off. It's really a trade-off about, do you want to turn this stuff over more quickly? And if you do, then maybe leasing at a little bit of a higher rate is a good thing because it allows you to turn over that equipment a little more quickly.
Well, it actually goes to one of the questions we have in the Q&A, which is, if equipment is leased, who owns it during the leasing period? And so that's, it's common across computer equipment or, a vehicle lease. The company that's providing the funds technically owns that equipment, and they are allowing you to use it for your purposes in exchange for making your payments. Question, what happens if payments are missed? Well, I don't know that we can necessarily answer that, because that's going to depend heavily on the leasing company and their relationship with you, how big of a liability it is on their books, how aggressively they want to pursue that. But there are, provisions in the agreement that would, give them the right to reclaim that equipment, I'm sure, as it went along.
Yeah, I completely agree. It's interesting. I mean, some leases, I guess, if it's more of a short-term basis, right? Again, the hardware as a service, for example, they do allow you, obviously, to be able to just return those items. So we do have some situations where, for example, let's say a construction company, they may want to own their base fleet of vehicles, for example, for a couple of sales guys. Maybe there's some site supervisors, so maybe they'll own or have long-term leases on 3 or 4 or 5 pickup trucks, for example. But then if they ramp up for a project and they know that project's only going to be 12 months in duration, well, then maybe they just rent those trucks just for that shorter period of time too. So they use short-term renting as a way of managing bulges, if you will, in their need for equipment.
Well, and I think that goes to part of our conversation we had in preparation, was about the cash flow implications, right? And that was, you gave me a really great spreadsheet where you analyzed this. So tell me about the cash flow considerations when you're looking at, this $50,000, acquisition, and how the different options affect, that component of your business plan.
Yeah, I mean, generally, when we look at equipment of any kind, you typically want to match the term of your loan or the term of your lease with the length of time in which you plan on utilizing that piece of equipment. So something like a server, for example, we've had good luck in terms of, typically 4, 5, 6 years, anywhere in between there. Of course, that depends. The rapid change of technology nowadays, maybe it's only 3 years of life of the server, I'm not sure. But you typically want to match that. So again, if you look at a vehicle, for example, well, do you want to have a 3-year payment period on a vehicle that you're going to own for the next 10 years, because that's the type of person you are and you want to get every minute of life out of that vehicle? If you're going to own it for 10 years, then maybe you should have a longer payment period to match that cash flow with the time period in which you're going to utilize that piece of equipment. So if you're looking at a similar, for example, a lease or a purchase over a similar time frame, let's call it a 60-month payment period for a server, for example, in our scenario here, under each option, whether you lease it or whether you get traditional financing over a 60-month period, it basically boils down to the interest rate. And in the example I sort of drafted up, I said, well, let's say you could get bank financing today at 8.2%. That would be about prime plus a half, excluding yesterday's interest rate.
I was going to say, yeah, this spreadsheet's already out of date.
Out of date immediately, exactly. but the payments would be very similar. Let's call it, $1,070 per month. And we do have some information from an example leasing company, and the rates they provided would be almost dollar for dollar. It's very, very similar at about 1,070 per month as well. So the rate that was implicit in that lease was very similar. Now that
Mhm.
lease had a fair market value buyout at the end.
Right.
So who knows, that leaves the door open that you might have to dole out a couple $100 or $1,000. I don't know what a 5-year-old server will be worth 60 months from now.
Yeah.
If you wanted a little bit more certainty and wanted a $1 buyout on your lease, then the payment becomes more like, say, $1,100 a month. So you're
Right.
really only looking at $30 a month more for the lease option. And the implicit rate in that lease was closer to about 9.35%. So it's only
Mhm.
about 1% more. So it's really not a huge difference, right?
Yeah.
So I think in this case, if you're looking at a 60-month lease at today's rates, maybe if you can get a traditional bank loan at a relatively reasonable rate, that might be slightly favorable for you.
Yeah. The key word there is if, right? And I think that that's part of the reason that leasing companies exist is that, I mean, my perspective, anyways, is that banks were not created to take risk. And so they might look at financing something like a server project like this, and they would say, well, it's $50,000, sure, but only 25,000 of that is an actual hard asset. The labor and the software licensing, like they're they don't really exist. So a bank might only provide financing on the hard asset, whereas the leasing company, they look at it and they go, well, this company, I mean, they can't do the labor themselves. They can't do this project unless they buy all three components. And so they finance the whole deal. And I mean, they might have, tighter, terms on their contracts and those types of things than what a bank would, because they are willing to take on, you know, like what we would describe as higher risk.
I completely agree. Exactly. They are willing to take on a higher risk, and that's why their rate is a little bit higher.
Mhm.
And as well, just under our example here, exactly like you mentioned, your banker might not want to lend you the full implementation cost of this project. So
Mhm.
the reality is you might have to put down 10, 15, $20,000 upfront and get bank financing for the difference. Well, not everybody has 10 or $15,000 that they'd like to commit to this type of project. So leasing gives you that ability to make those monthly lease payments rather than coming up and signing a big check on day one, right?
Yeah. Well, and that's what I wanted to talk about with the cash flow implications, because the first option is just red check. Now, in this scenario, we're basically talking 52,500, and I would imagine that if a client was sitting, or on the phone with you saying, "Hey, I've got to make this decision. How do I pay for this?" Part of the discussion would be, well, you might have that cash in your bank. What does it mean to you if it's not there? Because there's that opportunity cost when you do pay cash. you know Something comes up next week, maybe you have an opportunity to take a surprise contract, and you need to buy a bunch of supply or something, and now all of a sudden you're tight on cash. So paying the interest isn't necessarily always a bad thing, I think, right?
Yeah, I agree. You really have to look at, for example, what are your margins? Exactly that case. What if you have the ability to fulfill a contract and you know that your margins are 30%? Well, if I take that $10,000 and I put it out there and buy some materials, for example, that I can turn around and sell at a 30% markup, well, I just made $3,000. Well, that covers a lot of interest that I could be paying in the meantime. And
Mhm.
if you can turn that same $10,000 over a couple of times at 30%, you're going to more than outweigh your interest cost.
Right. And then it also plays in, and part of the reason we wanted, an accountant on the call is the tax implications are quite a bit different. If we purchase either through cash out of our bank or bank financing, so traditional like a loan financing versus a lease. So can you maybe just touch really quick on how that affects our P&L and our tax side of things?
Absolutely. Yeah. So option one, write a check, just buy it outright. In 2023, we have a few more months here, and we've got some favorable tax rules in terms of expensing or getting what we call capital cost allowance, or CCA. You'll often hear accountants talk about CCA. It's really depreciation for tax purposes. And if your equipment is in use, it's ready, it's available for use, and it's functioning effectively, as of December 31st of this year, of 2023, you can get full expensing of those assets. So you get a nice big tax deduction for the full 50 grand in this case.
Right.
Immediate expensing. Now that rule will change in January of 2024 and will revert back to what's more traditional, in the sense that you would get to depreciate the cost of that project because it's a computer related project. It would be depreciated at about 55% per year.
Mm-hmm.
So, and that's on a declining balance basis. So what that means is in the first year, your project is $50,000, you would get 55% immediate write-off of that. Now your balance just went down, and then you get 55% of that number, of that number, of that number in each of the next successive years. Effectively, in about 5 years, you've largely gotten the depreciation on it and gotten the tax savings. So it's really a nice big tax savings in year one, and then your tax savings get a little bit smaller in each of the subsequent years.
Mm-hmm.
As well, any interest you would pay if you had the same scenario and you just borrowed from your bank, you would get the exact same depreciation that we just talked about. The add-on is every year when each of your payments has some interest built into it, that interest is deductible.
Right.
Under a lease option, it's a little bit different. It's very straightforward. Your lease payments are just fully deductible as you pay them.
Mm-hmm.
And so it's very straightforward. It's whatever you're out of pocket for, that's what you get to claim as an expense. So your tax break is more linear. It's exactly based on the percentage or whatever tax rate your corporation's at over the term of that lease. It's smooth. It's not disproportionate as the purchase would be.
Right. Right. Yeah, and so I mean those are really good things, because you need to think about, like you said, what else would you do with the cash? What kinds of struggles or things would it cause if you didn't have the cash and an opportunity came up? It sounds like the write-offs at the end of the 5 years, it all ends up being the same, between any of the three of them.
Yeah.
Pretty.
You're right. Very, very close. There is a little bit of a push this year. I know I've got some clients that are looking at buying larger pieces of equipment. Well, maybe get the ball in motion to do those things before December 31st, get them into your facility and ready for use, because there is a nice tax advantage this year. So when CRA hands you an advantage, you generally want to try to take advantage of that.
And I feel like that has not been talked about or publicized a whole lot, or maybe I'm just reading the wrong magazine, but until you and I started talking about this, I don't know that I was aware of that one.
Yeah.
We do have a couple of questions here. So one of them, what happens if there's an equipment failure during the lease period and the warranty has expired? So, I mean, that's obviously going to be dependent on the lease agreement that you have. I believe the typical, kind of setup is that, I mean, you are operating and using that equipment. It's your responsibility to keep it in good repair. So if it fails and the warranty has expired, it would be on you as the user of that in order to pay for the repairs. I would imagine that on larger purchases, kind of what Richard was talking about, matching your financing term to the life or the expected use of the equipment, you'd want to have them matched up. I would imagine that there'd be lease companies that would say you need to maybe, if it has a 3-year warranty and you're doing a 5-year term, they might make you purchase an extended warranty so that it is covered.
Yeah. Or if they don't make you purchase that extended warranty, you may opt to purchase it.
Yeah. Will leasing a project cover labor costs in addition to the hardware? And yes, we basically talked about that. That is, I think, one of the key differences. You might find it challenging from a bank to get them to finance those soft costs, whereas leasing companies typically will. And then the extension of that question is there anything that leasing would not cover for a computer or network project? And in my experience, what they are typically looking for is they're looking for a ratio of hard versus soft costs. And so I kind of mentioned that the software, they might look at that as a soft cost. A lot of leasing companies, they do consider it a hard thing because there's tangible licenses to it, but they'll have some kind of ratio. They don't want more than 40%, to be labor, something along those lines. But your leasing company will decide that. And I think the leasing rate, again, might be adjusted depending on their perceived risk. So they might just say, hey, you know what, we can do that. You're going to pay an extra percent, or pick the number that's relevant to them. And then Martin is asking, what is the general time frame that most companies will lease IT equipment? So I think, Richard, the example that I gave you, I sent you a leasing rate table from a leasing provider that we've worked with, and they had options on there from 1 year to 5 years. And so, as the lessee, you had the choice of what term you wanted to put that over. I really like Richard's advice of matching your term to the life of the equipment. And so if we think about servers, right, 5 years is pretty typical because they usually come with a 3-year warranty. You can buy a 2-year extension fairly inexpensive at the time of purchase. So do it over 5 years. The desktop laptop side of things, we typically see more like a 4 to 6 year replacement schedule. And I think that most of the time leasing companies are looking for a 3-year term on those. Just, they're smaller, they're harder to keep track of. I think probably in today's world with, work from home and everything, I don't know that they'd want to go too long because those things can go missing fairly easily. Just looking at my notes here, Richard, I didn't have anything else on our notes. Did you have anything else that you think that's important that we need to touch on?
No, I think we covered most of it. The one big consideration as well is just how long you've been in business. A lot of times we'll see new clients and they just don't have the credit history that they would like to have. And they are sort of forced into a leasing solution because they can't get traditional bank financing. So that's the more typical scenario that we'll see with leases, equipment leases in particular, or even server leases. It's just a way for them to get financing, and even if it costs them a couple, 2, 3, 4% higher than a bank loan would, well, it gives them the ability to actually operate. Yeah, do what they have to do.
And it's kind of a funny point and a little off topic, but in my experience as a business owner, when you're dealing with the banks, if you need money from the bank, it's usually pretty hard to get it. If you don't really need it, but you play their game and you open that line of credit and it's available and that credit relationship, it starts by just little things here and there, right? So sometimes, even if you don't need to borrow the money, sometimes you want to, open that line of credit with your bank, dip into a little bit, pay it back, pay a little interest, let them get, involved a little bit, and over time they get more comfortable, and that relationship that you're talking about just gets more established.
Absolutely. The time to ask for a bank loan or a line is when you don't need it.
Hmm. Yeah.
Agreed.
And then I think we'll just do this one last question, and I don't know the answer to this, but it says, will leasing improve our business credit rating?
My understanding is any type of borrowing, leasing as well as financing does impact your credit history.
Yeah.
So the way I understand it is, yes, if you lease and you continuously meet those lease obligations, then yes, it would contribute toward a higher credit score.
All right. Well, we're at a half hour. I appreciate everybody taking the time to join. Thank you, Richard, for sharing all of the insight. Really appreciate it. If anybody has any questions that they'd like to follow up on, feel free to email me. I can put you in contact with Richard and people at his firm as well. And thank you all for joining. Appreciate it, and have a great day.